Very good morning to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 155th CP program organized by AASB of ICI this year. It is my immense pleasure to share with all of you that today we are organizing 155th CP program for this council year, and AASB has covered all the standards on auditing as well as various sectors relating to the auditing aspects. And today again we are going to organize this webinar on a very important topic, that is the key considerations in the audit of oil and gas sector. And in order to tackle this very important sector, we are having with us very eminent, very respected speaker, CA Vishwaranjan Sutarji. So on behalf of AASB of ICI, I extend warm welcome to you, sir. Namaste on this AASB webinar organized. We are also having with us two moderators, C. Anil Kumar Gupta ji and C. Achin Podar ji. So I also welcome Anil ji, Achin ji, both of you in this AASB webinar. I also welcome all the participants of today's webinar. So before we start the formal proceedings, I request today's moderator, Achin Podarji, to please formally start the proceedings of today's webinar. Over to you, Achinji, please.
Yeah, thank you so much. I welcome all the participants on this webinar, on this 155th webinar organized by Auditing and Assurance Standard Board of ICI. I also thanks Chairman and Vice Chairman, although they are not able to join us today for some unplanned urgent commitment. We'll see if they can join in between. So it's really thankful. I'm really thankful to them to give me that opportunity to moderate this session on such a key important sector as well as like a complex sector. So oil and gas, I think as everyone, we all know that it's not only complex because of their nature, but it's also become complex because the way the regulatory and legal framework they work within. So it's really an important and complex topic to deal with, and I hope that by the end of this session we all have a better knowledge, and when we are engaged in our auditing related services for these sectors, so we have some key takeaways that we can keep in mind when we perform any audit related procedure for these sectors. So as you all know, at the time of registration you must have a link, so I will request to make this session a big success. I would request each and every participant that please raise your questions, whatever you have, so that we will try to answer all of your questions by end of the session. Now, to take this session ahead, I'll request my co-moderator, Mr. Anil Gupta, to welcome and introduce our guest speaker for the day. Over to you, Anil Gupta Sarji.
Good morning. I welcome all the participants to 155th program of ICI. I am thankful to Chairman and Vice Chairman of AASB of ICI in absentia. I welcome CA Vishwaranjan Sutarji for accepting this opportunity for give deliberations on this topic, that is key considerations in audit of oil and gas sector. Sri Sutarji is a fellow member of ICI and an alumni of IIM. He has a vast experience in assurance and advisory in this sector and as well as in this large sector listed companies. He is a certified IFRS professional. He has been involved in various gap implementation. He has been chairman of ICI Bhubaneswar, and he has held positions in Committee of Corporate and Allied Laws of ICI and various other committees also. He has been delivering various lectures in-house corporate training at academic and professional institutions at state and national level. And I welcome Sri Vishwaranjan Sutarji to give deliberations, and I wish that all the participants should take care to note down what are the key consideration and ask questions wherever which are relevant to the topic. Thank you, and I welcome CA Visuranjan Sutarji to give his deliberations. Please.
Thank you so much, Anilji, for a brief, warm introduction on a very windy and cold morning. Respected chairman and vice chairman in the absence of the board, Chinji, of course, a very dear friend, Anilji. It's quite fascinating to see the committees and boards activity over the period of time, especially post-COVID. The energy and especially coming to these kind of sessions where micro topics are picked up, which goes a greater extent in capacity building of mid-size and small farms. Because normally when you go to seminars, conferences, topics are very broad and macro-based. And this is one such platform where you can detailedly discuss about with your fellow brothers and sisters that on a micro topic, and in actually it helps them to do their own capacity building while they discharge their functions at respective fields. So I am glad and happy and honored to be part of this endeavor of this board. And having said that, a topic which been chosen for today, oil and gas, is very close to my heart. In a sense, I got involved, got the opportunity of working in this sector, and since probably 2010, I am into this sector. And the quite amount of involvement this sector has seen and going to see is phenomenal. To just give you a backdrop of this sector, because I'm not going to detail about how the operations are going to do it, because the objective of this session is to deliberate upon the key considerations specific to the sector. I'll touch upon all the broad areas wherein as you provide your services, you need to focus on. But to at the beginning and the outset, to give a brief outline of this sector, the value chain, based on the value chain, this sector gets divided broadly on three terms or three divisions, I'll say. And broadly, it's called upstream, middle stream, and downstream. So if I put it in a very nutshell, like oil and gas, it starts with extraction of crude and gas. Then you go on refining, and then at the end, you go on distributing or selling to the ultimate user. So when you extract, it is called upstream activities. There are specific companies, those who are into upstream activities. Say in India, if I talk about ONGC, it's a very upstream company. If I talk about Oil India Limited, they are upstream companies. Then when it comes to processing of those crudes and gas for the end user perspective, these are the middle stream companies. There are specific middle stream companies like in India, Numaligarh Refinery, it's a middle stream companies. They don't do marketing of it. There are downstream companies. The oil marketing companies are example of downstream companies. But all these three segment of companies are part of the larger value chain of this oil and gas industry. When you talk about value chain, it also is very complex in terms of extraction. It involves a very huge amount of capital introduction. It requires state-of-art technology to process it, distribute it, and hence it requires huge amount of capital. And having said that, we are living in a country where we are deficit of natural resources in terms of crude and gas, and we import a lot of things from the foreign countries. So when I do that, it involves a very geopolitical, because crude, oil or gas are something which are very critical for security of a country or nation. And geopolitical plays a huge role in mapping demand and supply, tabbing on the pricing of it. So it is very critical, sensitive, capital intensive, and very peculiar in its industry. That's why it throws a lot of challenge in terms of how you approach these companies when you get the opportunity of doing audit. And when you get into this company, kind of companies for audit, it is very basic and very important to understand the nature of the business. And unless you understand the nature and the processes, it is very difficult for us to deliver what is expected from us. So I'll go one by one in terms of key areas which are very peculiar to this industry, not specifically in order of downstream or upstream. I'll specify wherever it is related to only upstream, I'll specify that. Wherever it is specifically related to downstream or middle stream, I'll specify that. But in order of chronology in terms of the value chain, I'll go one by one activities and what are the things we should be very careful about when you discuss our audit function in these kind of industries. Now, to start with oil and gas industry, the first and foremost critical part of is extraction of crude, and herein comes evaluation and development expenditure related to crude. There is a particular guidance note on this, guidance note on accounting for oil and gas. And this becomes a Bible for understanding the accounting and auditing of this particular expenditure. And this is very specific to upstream companies where they extract oil, crude, and gas, and they downtown to the middle stream companies. And there are few components which poses very challenging for us to understand. To start with, the first in order is the pre-acquisition cost. So this is something called, like in upstream companies, it is not that they get a patch of land where they extract oil straight away. There are very law mechanisms are in place. Government alerts areas, patches of areas to companies through licenses, and they get a periodicity in which they need to do all kind of surveys so that they ensure that this patch has a crude reserve which is capable of meeting the production and viability, and they go ahead. So in the process of acquiring this licenses and this patch of land where they are going to explore that whether this patch of geography has crude or not, or gas or not, they incur a lot of expenditures with this in terms of consulting fees, in terms of licensing, all those things. These are basically termed as pre-acquisition costs. So if you look at into the guidance note of it, the treatment of it, you need to be very critical in terms of identifying this kind of expenditure and accounting disclosure thereof. Second in order of this segment of accounting is exploration cost. So once you get a license, then you do all kind of studies related to that particular geography to ensure that how much crude or gas reserve is there in that area, whether there is a commercial viability in it or not. So these are called exploration cost, and these costs related to mainly into of geophysical and geological surveys. And there could be a situation of cost allocation, because you think about a company, those who are in-house capable of doing this kind of survey activities. So there could be a cost allocation from the main segment to this segment. So it includes third-party costs on geological and geophysical surveys. There could be cost allocation on equipments used for these activities. And how you dispense with this activity cost in accounting terms is again in line with that guidance note. You need to be very critical in terms of identifying, measuring what kind of amount you need to recognize and disclosure thereof. It is not necessarily that every amount you incur for exploration towards exploration cost has to be capitalized or needs to be charged up. Depending on the degree of viability, it gets decided upon that what kind of accounting treatment you need to give towards this particular kind of expenditure. And these expenditures normally are not taken in a bucket. Rather, these expenditures are divided area-wise, and based on how that particular area is behaving towards viability, the accounting and disclosure depends. The third in this line bucket of expenditure is development costs. And this development cost generally happens when you get proved reserve in a particular area. So first I acquire a license to explore and take my chances that this particular geography, whether it is going to have a good amount of crude reserve and gas so that it is economically viable or not. Once I get the licenses, I incur exploration cost to ensure that to pinpoint on the kind of reserves I'm going to have it in terms of economic viability. Once I freeze upon that, yes, this particular geography has good amount of crude reserve and gas, and it is economically viable, then I set that geography for production. And there are few expenditures I need to incur making that field a production purpose. And what kind of expenditures I do as clubbed as production cost. And again, accounting and disclosure of these expenditures has to be in line with of the guidance note I have discussed earlier. Guidance note on accounting for oil and gas industries. These are the four development. Then once I develop that particular geography, then I do production, actual production, where I extract the crude and the production cost come into play. So in this bucket of oil and gas industry, the first element, there are four verticals in terms of cost recognition, measurement, and disclosures. So pre-acquisition cost, exploration cost, development cost, and production cost. There could be a fifth dimension to this is site tracking cost. This is very peculiar to upstream oil and gas companies. What is site tracking? Site tracking, suppose, and this site tracking cost can be related to come up at the time of exploration or can come up at the time of development or production. Site tracking as like, suppose I'm extracting crude from a particular designated geography, and in geography, how I extract the crude is through wells. So while extracting, there could be a situation, some path will go dry. So I sidetrack that path so that I can extract oil from other side. So these kind of costs are called sidetracking costs. And the treatment, it depends what kind of well you are associating with, at what stage it is. If it is at exploration stage, if it is at development stage, the accounting treatment differs. If it is at production stage, the accounting treatment differs. So in staying with oil and gas exploration, evaluation, and development costs, they are the 5 elements you need to very critical and judgmental about it. And then again, the 6th component in this category is the decommissioning or restoration cost. Because if you try to understand how the oil and gas industry behaves, it brings a lot of ecological changes in the process of exploration and production. So it is necessary that when you complete your production in a particular geography, you restore back that piece of land or geography as it is without disturbing the ecology. So it has its own cost of restoration and decommissioning. And this guidance note also requires the kind of treatment and disclosures you do at the initial cost of capitalization of decommissioning and restoration cost. So this segment of accounting, recognition, measurement, and disclosure are very peculiar to upstream companies. And as an auditor, I should be very thorough in understanding what are the components goes in these buckets and how these components behave in terms of recognition, in terms of measurement, in terms of accounting, in terms of disclosure. So a clear understanding is required. And I believe once you dig into in a practical field, it will get a lot of ideas in terms of how this accounting has to be done. Now, as I said, this oil and gas sector is very complex in terms of operation, and hence it takes a lot of capital infusion and takes a lot of funding to it. So that's why one of the major areas in these companies are its PPE, because it is very capital driven industry. So in PP, there are very peculiar things you find in these sectors. One and foremost is related to leases. This sector, since it is very capital sensitive, it is not necessary the companies will have their in-house equipments to do and discharge the production of it. So they hire a lot of machineries, and this sector also deals with a lot of pipelines, because this product pipelines, be it placement pipelines or shifting of crudes from the wells to the refinery, or disposing of product oil from the refineries to the ultimate user through placement pipelines. So all these pipelines goes on a physical area spread out of thousands of kilometers. So it is not necessary for the companies to own this piece of lands for laying down their pipelines. So right of use and right of ways are there, so that paying some nominal license fees, they acquire this land so that these pipelines can be laid down. And this leads to a huge amount of lease accounting within these companies. And this lease accounting of right of ways, right of use, lease accounting of various equipments, our understanding is very critical, again in the second term, staying with the property, plant and equipment. So each segment of lease varies with the degree of contract the lessor and lessee has been entered with. The terms of the lease, the payment terms, the repayment terms, all the variable considerations of the lease are different from one segment to another. So it becomes very critical from our part to understand these lease contracts on a very right perspective, in terms of whenever we do PP or CapEx auditing of these companies. Another challenge could come up in lease accounting in terms of downstream companies. If you have seen these retail outlets of downstream companies, there are a huge number of retail outlets spread across the country. Any company will have 5,000, 6,000, 10,000 retail outlets. Each of these retail outlets not necessarily to be of the company's own premise. This could be a third-party retail outlet where I have entered with a lease agreement for the physical premise with that particular party. So if you see the amount involved in a particular retail outlet is very nominal, but in terms of volume, in terms of quantity, in terms of numbers, it is huge. So how you track of this lease accounting, you will find suddenly with the downstream company, there will be around thousands of lease accounting, thousands of lease assets. So how you categorize, how you are going to put it in a bucket, how you see that accounting practices are proper in terms of accounting standards becomes critical. So lease accounting of these assets as part of PP is very, very critical, and part of the audit process sometimes becomes challenging. One segment of lease accounting could be there with downstream companies specifically, because as I said, as a country, as a nation, we are more dependent on imported goods than our own indigenous goods, because we are not self-sufficient. There is a huge gap between demand and supply. So to meet our energy security, to meet our demand, we import a good amount of crude. And while importing, one element comes in is the transportation of crude while we import it from foreign countries. So that's how this vessel transportation comes in place, because crude being voluminous, it is not possible to airlift, or it is not possible to get it through pipelines, because you need to have huge amount of cross-country pipelines. So majority of the crudes we import is through vessels. So one element of huge lease accounting comes in vessels. Normally, vessels are divided into two category of contracts. One is something called is TC and VC. TC is time charter, VC is voice charter. What is TC and VC? I'll just, in a very some way, I'll explain it out. TC is like you think of something, you take Ola as a rental basis. So how it behaves if you take Ola as a rental basis, that you book a vehicle for a particular time period, and it is up to you how you use this vehicle between that time period. The destinations are not fixed. You can modify those destinations, and how you optimally use your vehicle, it depends totally upon you, and you pay the price for the period for which you take this vehicle. So time charters works basically in this broad lines, where I engage with one vessel or charter for a particular period of time, and how I use it for what is the quantum of usability is totally depends on me. And depending on my forecasting, depending on my contract base with foreign suppliers, depending on my price sensitivity, because this crude oil segment is very geopolitically motivated. So a lot of variable factors comes in when I decide upon a long-term contracts with my suppliers, in terms of pricing, in terms of periodicity. So, and keeping that in mind, it also becomes critical that my supply chain is maintained throughout the country, throughout the day. So for that purpose, a lot of advanced planning goes into this, and it becomes very critical whether I'll decide upon a time charter or not. So based on all these variable factors, company enter into agreement for time charter. And the lease accounting of time charter again is a very critical area to look into it. Voyage charter is like you take one voice contract from one destination to another. It is very specific, not time bound. It is destination oriented. Like you book in our day-to-day life, you book Ola Uber from this point to another point. So not of a period city involved. So voyage charters are short terms, and it is very specific to for a delivery. So understanding these concepts in this industry again becomes critical, and how the pricing of these contracts is made on a proprietary angle is also very critical. And when you try to understand these things in this particular industry, lot of variables comes in, and that becomes a challenge, because technically sometimes we are not equipped to understand these kind of transactions, because these are not purely financial transactions. Lot of operational data are involved, lot of estimates are involved, lot of forecastings are involved. So you need to take the help of experts wherever it is required to understand these kind of things. So in staying with PP, apart from your E&P assets, one major asset which you might encounter in this kind of industry is leases. And variety of leases comes into this place. And here in this industry, leases comes with whole lot of variable considerations. So lease accounting is something which you need to be very thorough on and proper in terms of understanding accounting and disclosure of it, and finally giving our assurances on it. Now I'm staying with this capex and PPE, since it is a very complex capital sensitive industry. You'll find very normal within this industry is capital work in progress. It is one such industry where you find capital work in progress spreading over periods of time. It is not necessary that you have capital work in progress which got built up over a period of previous year or current year. You might find a huge amount of capital work in progress over a period of 3 to 4 years, 5 years, and it is not necessary those CBIPs are suspended CBIPs or otherwise CBIPs. So this becomes a challenge, and understanding CBIP disclosures, accounting, and allocation, since it's a huge amount of CBIP and over a period of time. Again, third element comes into this in capex is borrowing cost. How the capitalized borrowing cost, and it is not necessary in this industry they capitalize borrowing cost on specific borrowings. That could be a scenario where they capitalize general borrowing cost on capex also. So be clear in terms of understanding, and this may vary from one company to another, the practices, but by and large it is the same. The principles are same, but be firm on allocation of cost into CBIP, be firm on capitalization of borrowing cost, since the periodicity of CBIP is little large, you need to be very judgmental and critical on whether appropriation of borrowing cost and capitalization of borrowing cost is appropriate or not. There could be a situation that my mechanical completion is done, but it is not ready to use because of some permissions, because of some licenses are awaited. In that scenario, whether you go ahead with capitalization of borrowing cost or cease the capitalization borrowing cost is also important. So staying within the capex and staying within the PP, first is your assets, second is your lease accounting, borrowing cost. Then the fourth element, which is also critical with this industry, since it is a very capital intensive and complex state of art manufacturing process, is capital stores, because these are very specific made to go industry machineries. So capital stores are kept so that to keep the refineries to the production establishments running. So that could be a situation of having huge capital stores within the companies. So be mindful of these capital stores and accounting and disclosure of this. So one obvious thing comes into this once the moment you say that this industry is capital sensitive and the quantum of fixed assets is huge. Two elements as an auditing perspective becomes challenging. One is physical verification of these assets, and second is impairment of these assets. When you come to physical verification of these assets, understanding of the business, understanding of the fixed asset becomes critical. It is not you go and see a refinery and say that exists. That could be a huge componentation goes into this kind of industry. So understanding the overall outlook of this capex, overall outlook of PP gives you comfort on the physical verification processes. Yes, physical verification process could be a challenging because it is very spread out depending on the industry. If it is a very upstream, then you have equipment spread out of geographies. If you are middle stream, then it is within a confined boundary because refineries are not spread out. It is within a confined boundary. If you are into downstream, then again pipelines, all those things are very spread out across geographies. So physical verifications might pose a challenge in this industry. Second component in terms of auditor's perspective is impairment. So in impairment is very challenging in terms of industry because a lot of outside factors comes into play when you do impairment testing of these industries. There are two components which I feel is very critical in this industry is identifying what are the assets combined together, put together, can be said as CGU, because that is a very basic thing which you need to do as part of your impairment testing. So once you freeze on what are the assets singly or as part of a bucket clubbed as CGU, then you derive on the cash flows. And in cash flows, when you arrive at the cash flows and compare with your carrying value, a lot of estimates goes into this. And in this particular industry, a lot of informations are not available on over a very long horizon. And this kind of industry requires you to put cash flows for a longer period. 3 to 4 years, 3 to 5 years, 7 years cash flow won't be enough for you to do and justify your impairment testing. You might need cash flow projections over a very long period of time. So when you need cash flow projections for a very long period of time, the variable considerations get embedded into this becomes very critical, and the number of variables becomes more and more. And unfortunately, in this industry, though a lot of informations are available, but those informations are not over a very longer horizon. And if even though few informations are available over a longer horizon, the reliability of those information, the certainty of those informations becomes very critical. So as an auditor, you need to be very focused in terms of understanding of these aspects of impairment, how it is getting tested, what are the factors which has a potential to influence your testing, or your audit process, and what kind of riders you can take in the process of impairment testing becomes critical. So staying again with PP, we talked about normal physical assets. We talked about lease accounting within the PP. We talked about capital stores. We talked about physical verifications. We talked about impairment. Now, once I do production, once we do the understand the PP part and get the product, then the thing comes in the flow of line is production and revenue. The COGS or revenue, I say it in these terms. In terms of revenue recognition, this again is very specific to this industry. Yes, the broader principles of revenue recognition is same. If you talk about Index 115 across the industry, it is same. But there are very specific terms comes into this play as far as this industry is goes. When you talk about the upstream companies, the revenues are pretty much mapped based on long-term contracts they got into with refineries, with the downstream companies, because the buyers are limited, the players are limited in the sector, and the contracts are little longer term, long-term contracts. So the long-term contracts specify quantities, the pricing, the variables in it, and the revenue recognition has to be strictly on these lines. And in the hindsight, one subtle element we need to be very careful on this, and I'm little diverting from revenue, is if you see the billing of it, if you see the recognition of it, especially with the upstream companies, the billings are done on USD terms. So there could be a situation where for the auditor it is relevant to assess the functional currency of the company. That would this not be necessary that in India the INR has to be functional currency. So you need to evaluate on terms of primary numbers and secondary numbers, that what is the exact currency of this company and what is the functional currency. And sometimes it might surprise you that functional currency may not be INR. So I thought it is critical to know. So be critical on this while you evaluate the functional currency of these companies, and based on primary and secondary numbers. Coming to downstream companies, the revenues are more spread out, because upstream, unlike upstream companies, they only supply crude or gas to the middle stream or downstream companies. But when you come down to downstream companies or the production companies, the lines of revenues are different, and recognition of these revenues also varies from one to another. In terms of petroleum products, broadly both are divided in two categories, two verticals. One is petroleum products and second is petrochemicals. So in terms of petroleum products, again, though in India it is a deregulated market today, oil companies are open to decide upon their pricing, but understanding the pricing mechanism is critical, and understanding pricing mechanism vis-a-vis production costing is also becomes critical. So there could be a one-to-one sell and pricing, retail pricing, then retail recognition of revenue one segment. There could be sale of products to institutions. So when you talk about institutions, basically is a large institutional sales where these sales are made on dotted line contracts. So understanding those contracts, that conditions, stipulations in those contracts, fulfillment of those contract conditions, then subsequently and consequent revenue recognition also becomes critical. So that part we need to take care of it. When you talk about retail sales, now loyalty points is one area which is very peculiar to this industry. You need to talk about loyalty accounting, its valuation, the recognition of liability, because loyalty points are given when suppose you go and fill in your petrol or diesel of your car, you get some loyalty points against your purchase, and these loyalty points is not necessary you redeem it on then and there, you accumulate it. So that accounting is very specific to this industry, how they create liability against this loyalty point, how they reassess what will be the future redemption becomes critical. So this is related to sale of product. When you talk of sale of gas, there are two components nowadays is little getting explored. One is LPG. Again, as I said, petroleum products are market deregulated, but when it comes to LPG, it is regulated. The LPG prices, at what price I will sell to the consumers, is regulated by the government. So here, when something is regulated accounting comes into play. So pricing, cost, and the mismatch between actual sellable price and at what price I'm selling, that buffer accounting is again critical to downstream companies. Nowadays, if you look around our societies, that gas pipe connections are getting into this. So this is in industry segment. It is called CGD, city gas distribution. And this city gas distribution could be a retail gas distribution or institutional gas distribution. Depending on that, how you recognize revenue, how you have a internal control over these processes of meter reading, supply of gas, and collection thereof is again a typical segment to understand in terms of revenue recognition and recoveries there too. When you come down to lubricant, petrochemicals, there is again a huge segment to understand. The lube sales, its production, all are different segments. So in a sum, if I tell you how much critical it is revenue recognition in oil and gas sector, as far as upstream companies are concerned, it is little easy once you understand all those agreements. But when it comes to downstream companies, the volumes are huge, and the line of products and SKUs are also huge in quantity and numbers. So having an internal control IFC check on this could be a challenge in terms of auditing in these sectors, but downstream has its own criticality to understand. Similarly, when we talk about pricing and revenue, COGS becomes important. And when you talk about COGS, what are elements goes into a production of those products are clubbed together, and few things which are very specific to these industries elements are again critical to understand and appreciate. As part of COGS, one element could be catalyst, use of catalysts, that is typical in this industry. COGS in terms of additives, terms of chemicals, these are very specific to this industry. So you need to understand in detail. One more thing I missed out when I talked about revenue recognition is with related to institutional sales. Because when you sell to institutional sales, there is something called fall clause liability, and this is again specific to this industry. Fall clause liability goes this way. Suppose I am selling to a particular institution on a very long-term contract. There could be a clause in that agreement that at some point of time, my retail sale pricing goes down to the agreed price what I am selling to this institution. Then I need to match the price of a retail price so that they get benefited. This is called fall clause liability, and this is very specific to this industry. We have started with production, we have started with capex, we have started and then saw a bit of revenue. And when you talk about production and revenue COGS put together, the huge number comes in terms of inventory. So this industry again has a peculiarity of audit perspective, it's inventory. And valuation of inventory, physical verification of inventory becomes challenging sometimes. So you be sure on cost allocation, what are the costs and components are getting involved and clubbed in arriving at the inventory, how NRVs are taken. It is not necessary that NRV will be plain vanilla in every segment of this industry. There could be a challenge in getting NRV. Cost, of course, is a challenge. So once you pinpoint on the components of cost, what gets into the crude cost, what gets into a final product cost, what gets into petrochemicals product cost. So once you understand the costing part of it, then inventory valuation gets easy for you. And again, a physical verification of inventory is also a challenge, because one is in terms of quantity, they are very huge, and in terms of spread out across geography, again, it is very spread out. So physical verification as an start auditor or as an internal auditor, how you test these inventories, how you ensure that the physical quantities are in line with books, how you take deviation of these accounting is a matter of challenge. But yes, in this sector of oil and gas, inventory is one of the key considerations an auditor can look into. Next element, if I think of what should be the critical area, as I started with the deliberation, we saw that how critical geopolitically this segment is. So if something is geopolitically influenced, and especially in our country where there is a huge gap between demand and production, and we are depending on foreign countries for our meeting our demand, and geopolitically can influence both supply of quantity of crude and pricing of it. Normally, companies safeguard themselves by entering into long-term contracts. And when you enter into a long-term contract, there is always a risk element of price, and there is risk element of fluctuation in foreign exchanges, because majority of our imports are from foreign countries, and when you deal with foreign countries, foreign fluctuations comes handy. So there is a both way challenge in terms of variations in foreign fluctuations and variations in pricing because of geopolitical situations. So it is very evident for the companies and normal for the companies to get into forward contracts, derivatives, and hedging. So one of the key element as part of key audit considerations could be in this sector is understanding of derivative contracts, embedded derivative contracts, and hedging contracts. And this could be in terms of size, is sizable, and you need to be thorough in understanding the accounting of it, disclosure of it, and going through that basic contract itself. Because once you go through those contracts, then you only come to know that about what kind of contract it is exactly, whether it is a derivative contract, whether if it is a hedging contract, whether there is a chance of embedded derivative in that contract. So based on that, you see and ensure that measurements are in right track, accounting of those measured numbers are on right track, and appropriate disclosures are made. So as an auditor perspective, derivatives and hedging exchange fluctuations matters a lot in these kind of industry, and these are very prone to this in a very subtle way. Next, when you talked about derivatives, when you talked about capex, borrowing cost again becomes very critical, because it's a very capital intensive industry, and companies do require sizable fund not only to sponsor their capex but also to sponsor their imports. So a larger planning goes into what kind of borrowing they do. So in these kind of companies, you will find all varieties of borrowings, be it plain term borrowing or working capital borrowing from the banks. And there are bonds they issue, the GDS they issue. So all sorts of borrowings you will get to see in this kind of industry. And so understanding each component of the borrowing becomes critical. Understanding what is the nature of borrowing becomes critical, because based on the component and nature, the accounting differs, and based on application of accounting standards also differs. So understanding of borrowings, borrowing cost, guarantees, these people, because it's a capital intensive industry, as part of ensuring the growth, sustainability of the product, sustainability of the supply chain. They also get into a lot of foreign operations. Foreign operations in terms of JVs, in terms of joint operations, in terms of associate companies, in terms of subsidiary companies. So when they get into this and part of the operational process, they also forced upon to extend guarantees, both operational and financial guarantees. So the moment you extend financial guarantees, the valuation of those financial guarantees again comes handy. And in this kind of industries, you might find a lot of financial guarantees coming into play. So please ensure that you understand these transactions, accounting and disclosure there too. Second is, as I said, to ensure the sustainability of the business, to ensure the sustainability of the security of the country, to ensure the supply chains are maintained throughout the period, throughout years and future viability. They get into different arrangements with different companies, be it by way of subsidiaries, by way of associates, by way of joint ventures, by way of joint operations. All kinds of permutation combinations you'll find in different segments. There could be a situation a downstream company may end up having a subsidiary with the upstream companies, may have end up having a joint operations with the upstream company in an offshore or onshore mechanism. So all those complexity brings down to consolidation and business combination. So consolidation and business combination throws a huge challenge in this sector, and you need to be very thorough on understanding the components, aspects of business combination and business consolidation. And not only the transactions are huge, and these could be in terms of numbers, there could be variety of transactions and exchange fluctuation. So you need to have a qualitative team and understanding on these transactions in terms of understanding business combination and business consolidation. Staying in the subject, another one key component which clicks my mind could be a key consideration while you do audit of these sectors is grant. Because these companies, be it private or public sector companies or PSUs, are very sensitive to the government security plan. So there are a lot of government machineries who extend grants to these companies, and these grants could be in nature of capital and revenue. So grant accounting is one component which are there in this kind of industries. You won't find government grants in any other sector. There are very few limited sectors which attract government grants, and oil and gas sector is one of such sector which gets government grants both in terms of capital and revenue. So please be critical on those, understanding what are the government grants one company is having. It is not necessary that a company will have only one set of government grant revenue or capital. There could be different multiple set of government grant for different segment of activities. So you please try to understand what are the grants a company is eligible and availing, and what are the terms and conditions of those grants, whether those terms and conditions are met, while you ensure accounting and disclosure recognition of those grants, and distinguish between these two grants, whether it is revenue or capital. So based on that, the entire accounting treatment varies. So this could be one of the key considerations one might think in this oil and gas industry. Then coming to another key component, audit component which clicks my mind is contingent liabilities. One might say that contingent liability is the same across industries. In every company will have contingent liabilities. But why I'm specifically saying this in this sector is because it is very spread out, because the numbers are huge, quantities are huge. The volume of contingent liabilities in this segment is huge again. There could be, because in a retail segment, you have a lot of contingent disputes over consumer agreements. There could be lot of consumer disputes over your contract agreements. There could be a huge amount of disputes over your supply chain agreements. There could be disputes or arbitrations related to capex. There could be statutory disputes also. So number of contingent arbitrary cases will be huge in these sectors, and it is not necessary that everything is a contingent liability. But having said that, the number of disputed cases in these sectors will be huge, and having a control of those disputed arbitration cases, understanding those cases, and segregating those cases into possible, probable is important, and that's why contingent liability can throw up a challenge during the audit of this sector. And certainly this fits into the list of one of the key area considerations when you do oil and gas accounting. Then another line item which triggers me to put it in key consideration elements as far as this industry goes is receivable accounting, and this is specifically to downstream companies, because when you talk about downstream companies, the consumer base is huge, because this is a product which every household uses. So basically, if you're talking to a number of consumers, or the size of the consumers you have, is basically you have the entire nation as your consumer. So when you talk about the consumers base is large, it is not necessary that you sell your product cash and carry. So there could be a sizable amount which you supply on credit lines, and receivables will be in good number. And when you talk about receivables, provisioning against this receivable ECL accounts, ECL accounting of these against these receivables becomes challenging, and financial assets becomes challenging. One element with staying with this is that when you are dealing with in downstream companies with many consumers, and these supplies are not one-time supplies. You need like to have a company like to have retain consumers over a period of time, and it is a concurrent supply and of recurring nature. And when you get engaged with a recurring nature supply to any customer, element of security deposit comes into play. And how you and there are few equipments also you give to the consumers, like LPG cylinders you extend to consumers. So there could be a asset of your which is placed at consumer's place. So that interplay of assets, liabilities, security deposits, receivables, ECL accounting on those financial assets might be a challenging and critical because of the number itself and the quantum of the number itself. So bucketing for ECL accounting is a challenge because you have different sectors, because this sector has peculiarity in terms of one segment is regulated, another segment is regulated. So based on the regulation, your pricing changes, based on the regulation, your recovery changes, and your bucketing also changes for ECL accounting. So that could be a bucketing for general public, that could be a bucketing for regulated pricing supplies, there could be a bucketing for industrial supplies, there could be a bucketing for government supplies can be. So ECL understanding these financial assets, financial liabilities, assets against these financial liabilities, and ECL accounting could be a challenging, and that's why I thought to put it in key consideration element. Going on this line, another thing which clicks my mind to put it as part of key element when someone drops in to do audit of these segments is estimates and assumptions. Probably in my little experience, what I have, the kind of assumptions and estimates these industries do are huge. And at times you feel we are not technically qualified to appreciate these assumptions and estimates. The first in terms of estimates and assumption is starting, I'll go back and it will be a kind of revision also. I'll go back to the development E&P cost, exploration and development costs. And there, everything is based on the amortization of those costs, capitalization of those costs is based on the production reserves, how much crude and gas you are having underneath. And that reserve estimation is purely technical, and whether well is getting produced or well will get dry, or whether that well will be disbanded, it all depends on those numbers, and those numbers are purely technical, and these technical numbers has an influence on financial numbers. So as an auditor, I need to understand these technical numbers, not in respect to how these technical numbers getting arrived. I should at least be aware of what is the process of getting these technical numbers in terms of reserves, and what are the components, what are the factors goes into this in arriving at these numbers. If required, do take help of technical experts in these lines, because these technical numbers are not our cup of tea, and we can only appreciate the process in terms of understanding, but actual arriving at the number could be challenging in terms of understanding. So do take the help of experts. While you take the help of experts, please ensure that you comply required auditing standards which are applicable to us, and do this. Again, in terms of assumptions and estimates, after this production reserve is impairment, as I said, there are many variable considerations, and these variable considerations are outside variable considerations. It is not under your control. So these variable outside considerations could be a challenging thing. In coming to PPE, there could be huge estimation goes and assumptions goes in terms of fixing useful life and residual value. If you see and pick up any annual report of any company in this sector, be it private or public, you suddenly feel that the fixed PP depreciation schedule is not in line with Schedule 2. There could be a situation all the plant and machinery useful life will be different from the standard useful life, because it is obvious so, because this industry is very peculiar and specific. Based on the experience, technical advisory, the useful life of these machineries are being fixed, and residual value also being fixed based on industry practices and industry experiences. So these again are based on assumptions and technical studies the companies would have done. So when, as part of our audit process, it is not necessary that we settle ourselves that we are putting a disclosure that useful life of this particular class of asset ranges from this year to this year. No, you need to understand what is the rationale behind that, why it is differing from the normal useful life of similar assets and residual value. You try to understand, appreciate what are the mechanisms and thought process has gone in deciding this useful life and residual value of these assets, and post that you ensure that yes, whatever I'm giving assurances upon are okay. So estimates and assumptions again plays a very critical role in terms of PPE. Then, as I said, ECL accounting is challenging. So ECL requires a lot of estimates and assumptions. Taxation estimates, because these are very peculiar industry and specific industry. Lot of tax benefits are available to this kind of industries. So in those, a lot of estimates and assumptions goes into play. So taxation could be a key consideration area for auditing in this sector. So overly, if I see and visualize what are the key considerations I need to take during the audit of this sector, is first is your exploration and development expenditure. Second is your PP, and whenever you talk about PPE, please talk about lease accounting, because this sector has huge amount of and huge number of lease accounting to do with. Production costing and pricing is one, again, major area to look into. Inventory, of course, yes. Derivatives and hedging is part and parcel of this industry. So that becomes automatically a key element in this auditing processes. Then borrowings, consolidations, business combinations, government grants, contingent liabilities, contingencies, financial assets, and estimates assumptions. These are the broad key elements or key considerations one need to keep a tap on while doing the audit of oil and gas sector. These key elements I am saying based on my experience goes with this kind of industry. There could be a different key consideration on this industry. I just pop-up message. Just let me check it. I'll try to deliberate on it. Can we get some practical examples of PPE? Practical examples of PPEs are depending on what kind of industry you are into, whether it is downstream or upstream, the PPE varies. If I talk about downstream, you have in PPE, the larger buckets will be your refineries, your pipelines, your bottling plants, your terminals, your lube plants, then all the distribution assets you have. All these are PPE other than the general PPEs you have. And staying in the refinery, there are many components in the refinery and very technical to understand it. And again, CGD, if you are into downstream and you are into city gas distributions, all those assets will be very unique in terms of understanding. Then in upstream, apart from the normal PPE, what you see, office equipment, furniture, fixture, vehicles, rig equipments is one which is a major element of PPE in upstream companies, apart from your well asset. So rigs are and drilling equipments. So these are specific PPEs in terms of this industry. Any questions right now do you have, sir? If you can take it up.
So I want to ask about sustainability factors.
Yes.
How the sustainability factors are being taken care of in the present oil and gas industry, and whether they can be more sustainable efforts can be undertaken in this oil and natural gas sector.
Okay. It's a good question to understand in terms of macro economics of this sector goes. And when we talk about sustainability, I'll divide this sustainability in two parts. The sustainability of the business itself and sustainability within the process. When you talk about sustainability of the business, when you talk about oil and gas, the first thing comes in our mind that in consumption, because my revenue comes from sale of products, say petrol and diesel, and slowly as an economy, as a society, we are carving out ourselves from this to electrical vehicles. And electrical vehicles, passenger vehicles, in some way will reduce the consumption of diesel and petrol. So does it mean that whatever assets we have built is going towards an impairment? Whether the revenues of this company will be a challenging tomorrow, that is one component to look into. And in this sector, many companies are diversifying themselves into EV segments also. There are new products they are coming up with to minimize the sustainability challenge to a greater extent in terms of pricing. Now, if you heard of, they have started blending with ethanol. So when we talk about sustainability of this sector, sustainability is not always of the business processes. It is always more of environment also, and that becomes very complex and challenging. Um, One more factor I can tell you is zero carbon emission. We are, as a country, we are
Right.
targeting that zero carbon emission soon as a world.
2030.
Yes, net zero. But naturally, if you see, the refineries are against zero carbons. Refineries produce more carbon. So that's a challenge, how you make carbon nutrient this industry. Refineries, they do generate carbons. So what technological change they can bring in? Huge R&Ds are happening around the world. In our country, they are doing R&D. How they make refineries more sustainable, less carbon free. So it's very complex in terms of business processes and business itself. So impairment is a challenge in terms of business itself, but business processes, lot of things, renewable energy is coming into play a handy way. And if you see this renewable energy REC certificates, these oil and gas companies are need to balance them out by buying these REC certificates, because refineries are against carbon. They generate carbon. So it is little complex, and very fine tuning is required in terms of balancing this sustainability, both in terms of sustainability of the business and sustainability of the environment. Because these two components, these industries have a direct correlation and impact.
Further, lot of valuations and lot of estimates and lot of lot of uh, lot of centers or
Yes.
stock holding or consignment stocks and all kind of things are there. I believe that
Sorry, sir,
this
I'm not
sector,
able to hear you out.
this sector, this sector has this sector requires lot many estimates, lot many
Yes,
valuations, and lot many valuations at lot many places.
correct.
Right. So I believe that with the you can with capacity building
Hmm.
of small and medium firms
Hmm.
at various places in India, we
Hmm.
can we can have their skill development and capacity building of small and medium CA firms so that they can be help to you, and you can, I believe you can, means the auditor or assurance partner or risk assessment partners, they can take their opinion, and both are benefited.
Correct, absolutely correct, sir. But one of the challenging, it's a very insight thing which I am saying you. The valuation and verification of the assets
Inventory,
of this
inventory as well.
of these assets and inventory in this sector is very challenging, because you need to understand the technicalities of verification and measurement. So once you understand the technicalities of measurement and verification, then comes the valuation. And
Right.
valuation also, there are many layers in that valuation, and it requires a lot of understanding of those technical numbers, technical processes, and technicalities itself. So normally small and medium firms, we are habituated with the normal plain vanilla way of physical verification and valuation.
Right,
So
right.
once you get into this physical verification mode of oil and gas industry, you need to be little more pro in terms of your homework
Right.
and application of your knowledge, because it is little different and new. I won't say new, it is little different from the normal physical verification, measurement, and valuation. So, but what you said, absolutely right, sir, because since the geographies, the inventories are spread out, we can
It
play
is
a
also
handy
spread
role
out.
in terms of this activity.
So skill development, I believe skill development of small and medium CA firms will be an added advantage to both of you, both of both the partners, assurance partner and risk assessment partner, and also to the
On
small and medium firms.
on that, I can only say that Anil ji is the right person, because from the institute side, if they can navigate
Many
this
we
bridge.
can ask chairman of the AASB also. We can
Yes.
ask, say,
But Anil ji is the first ladder in that process.
right, of course.
So, Vishwaranjan sir, so I have one question.
Yes.
Uh, as you rightly mentioned, that being the technical nature of this industry, there are a lot of assumption and estimation when we talk about. So my question is more on decommissioning liability or asset restoration. So because it's more a non-financial area, like when we start computing that, so there are a lot of assumptions which are non-financial background, a lot of engineering is involved. So being an auditor or an assurance partner, what kind of documentation or what kind of checkpoints we can have in place to make sure that the assumption, because I have seen sometimes there are huge change in the estimates for these kind of provisions on the balance sheet of companies. So as an auditor, what kind of checkpoints we can have when we evaluate or review these assumptions which company has taken place in their closure model or decommissioning liabilities?
Yeah, fantastic question to answer to. It's my happy that you put this across. There are 3-4 components becomes critical to understand this. And the first component is like in upstream companies, the authorities, the regulator has given a mandate and they have given a guideline that how much should be the decommissioning liability, or what are the components on which you built on your decommissioning liability, which is not the same case for downstream companies. So for upstream companies, one base you have is the regulator has given a guideline for you. Okay. Second is based on that guideline, how you calculate those numbers. So when you calculate those numbers, two things comes handy. And at the time of calculating this number, this rule can be same for downstream companies also. Though legally in India, what is happening, decommissioning liability, whenever it is mandatory from the regulator, we are doing it. When it is not mandatory, some companies do, some companies don't do, because it is not legally mandatory. But as a matter of accounting prudence, we should be doing it, because sometimes decommissioning liability can be huge. So you take protection of that future liability by taking as your initial cost today. So when you calculate those numbers, one needs what are the elements or what are the activities which goes as part of your decommissioning. So identification of those activities becomes critical. So you need to ensure the completeness of activities, what you're supposed to do at the time of decommissioning. That has to be proper. Second, once you identify that activity, what are the rates you apply for that activity? Because the rates I'm having today, I'll be doing that activity of tomorrow. So I'll take the rates, industry rates of, say, labor, the service cost, whatever. Say I have 10 activities. So for those 10 activities, what should be the cost I'll be incurring tomorrow or today? Then the rates, because I need to arrive the future value, then discount it today. So I need to extrapolate it, then I discount it back. So what rates I am taking? So when you take rates, you not only take the inflation rates, and when you talk about inflation rates, whether you are going to take wholesale inflation rate, whether you are going to take a retail inflation rate, because this industry, the decommissioning activity is purely labor intensive sometimes. So wholesale inflation rate may not work it out. So what kind of rate you are taking and what are the components in those rates? That becomes critical, and how you discount it. So, and this estimates, remeasurements has to happen every reporting period. So what is the consistency, whether I'm maintaining it is not that today I say that these 10 activities I'll be doing at the time of decommissioning, but next year when I'm remeasuring, out of those 10 activities, 2 activities are gone, or I'm adding 3 more activities. So what are those trigger points in those modifications? So if I understand each of those pillars of these or the components of this activity, I feel we are, as an auditor perspective, we are safe in terms of understanding and appreciating. Because at the end of the day, it is judgment, and the judgment involves a lot of subjectivity. Only thing, what is the rational I'm building behind those subjectivity is critical. So if I tap on those things, I feel we are on track. I believe I have answered your query.
Of course, you have.
Thank you, sir. Yes, sir. Achinji Shed has dropped out due to the network issue. Anil sir, you are having any question, other question?
No, I just want to know how, whether you are taking the foreigners part also, means foreign companies having their assets and having their interest in Indian companies or Indian source or Indian exploration, or whether we are doing some work for foreign companies also in India.
Yes, it depends on the arrangements. Of course, yes.
Of course, yes. Okay. And whether there are specific challenges in their assessments, in these assessments.
See, across industry-wise, the in terms of accounting disclosures, it is more or less same. There are few items like, as I said, decommissioning. In
Right.
India, we do it only if the regulator is mandates us. Some companies don't do, since there is no mandate to recognize it. Outside, it is mandatory. So country-wise, some elements differ. That way, the accounting differs. Otherwise, on a primary understanding, more or less, it is same.
So, Vishwaranjan sir, one more question.
Yes.
I think you already touched upon that in terms of, like, we can see there is a lot of noise around climate reporting. There is a lot of noise around that how much a company is spending on climate related projects and how they are. And as you said that these industries, these sectors are quite emission intensive. So as an auditor, how we can value add it to our clients, or what kind of checkpoints or reporting points we can keep in mind when we talk about those climate reporting, because that is something I think people are talking about is a future era when I think there's a lot of things that need to be taken care of at the assurance side when we do perform audit related services for these emission intensive industries.
To put it in a right perspective, if I say so, right now we are a little far from integrated reporting, but yes, sustainability reporting, BRSR reporting started last year, and companies based on, because these targets are not of a particular individual company, this is of the country. And as a nation, once we give a target that we are going to achieve this for the greater cause, companies are also fall in line, and every company got their own targets of setting it. And every company has their own set of plans, because similar plans cannot be replicated in every company. So it is very individualistic approach by the companies. Every company got their own set of plans, how they are looking into it. And today, if I see, based on my experience, they are very initial stages of those plan implementation, because these plans, these targets are not going to be achieved over a period of 2 to 3 years. It's a very longer period horizon objective they have taken it. And it is, of course, so, because a lot of things need to be realigned with the production process, with the distribution process, and as a thought process, how the company behaves and the industry behaves. So it's a very long run approach what the companies are taken up. and we are initial stages of the ladder, what we are ultimately going to achieve after, say, 15 years, 20 years, 30 years. As far as audit is concerned, our fraternity is concerned, those who are doing BRSR reporting, they have started putting their muscles in terms of value additions, in terms of assurance. But purely in auditing perspective, other than the BRSR, what are the regulations are there? What are the compliances are there? I think we are on track in terms of delivery. And it is going to evolve only over the period of time. Today, it is kind of R&D is going on. It is not that this is what is right, this is what it is wrong. Lot of evolutions has to happen in this field. And I'm very positive on these lines in terms of both development in the process side and development in the assurance side.
Thank you so much, sir.
Any other question, Achin sir?
Maybe the last one, maybe the basic
Yeah,
one.
please.
I'm going to the basic again.
Please.
So you talked about, sir, the guidance note we have for oil and gas industry, right? But we also
Yes.
have India. So maybe if you can just explain how these India's requirement and this guidance note gel together, and whether the guidance note is applicable fully, or are there any carve-outs in terms of India's or this guidance note that we need to keep in mind when we talk
See,
about
this guidance note on oil and gas industry accounting is very old one. And
Exactly.
when Indes came into picture, normally all these industries are Indes compliant only. But if certain items are not addressed in a particular index, then it has to be looked into the guidance note. Now, post implementation of the index, this guidance note also got revisited, and the current set of guidance note on accounting for oil and gas sector is realigned with index. So if you see the name also, it is okay. So in that way, the bridge is there. So there is no difference.
Okay, that's perfect. Thank you so much.
Yeah.
Thank you, sir. Thank you so much for your wonderful deliberation. In spite of having your busy schedule, in spite of having your flight, you have given your kind consent to deliberate today in the early morning. So, on behalf of AASB of ICI, I extend my heartiest thanks towards you, sir, for
Thank you
sparing
so
your
much.
valuable life, as well as enlighten all of us on various intricacies on this very, very important topic. And I also thanks to both the moderators, C. Anil Kumar Gupta ji and C. Achin Poddar ji, for giving their precious time as well as moderating this webinar. Thank you so much, Anil sir. Thank you so much, Achin sir. Thank you so much, Vishwaranjan sir. Thank you so much. Thank you.
Thank
I also
you.
thank
Thank you so
all
much,
the
sir.
participants of today's webinar. Thank you, sir. Thank you.